Well, back home, Recep Tayyip Erdogan has plenty to think about. What with inflation hitting a 20-year high, it's time for business. Let's say hello to Kate Moody.
Hi, Francois. Double-digit inflation has become the norm in the last few years in Turkey, but these new figures are now the highest in 2 decades. Consumer prices soared nearly 49% in January compared to a year earlier. They were up 11% from December. Official statistics show that food and drink prices were up 55%, transport-related prices up nearly 70%. Well, a separate unofficial survey is even more dire. It puts that inflation figure at more than double that official figure, 115%, according to, once again, the unofficial ENAG research group. The Turkish lira lost 44% of its value last year. Prioritizing credit and exports, Recep Tayyip Erdogan has repeatedly pushed the central bank to cut interest rates. Traditional economic theory argues that higher interest rates tackle higher inflation. The government has also raised the minimum wage and offered aid, but many households and businesses are struggling, and analysts increasingly agree that Erdogan's monetary policy experiment has failed. Well, the Eurozone is dealing with record inflation of its own, 5.1% in January, but the European Central Bank has resisted pressure to lift its own interest rates. The ECB said it would continue gradually to reduce its emergency bond buying this year, acknowledging that higher levels of inflation were persisting longer than expected. ECB President Christine Lagarde said the key deposit rate would stay for now at negative 0.5%, but she didn't rule out the possibility of a shift later this year.
Although uncertainties related to the pandemic have abated somewhat, geopolitical tensions have increased. Furthermore, persistently high costs of energy could exert a stronger than expected drag on consumption and investment. We are going to use all instruments, all optionalities, in order to respond to the situation.
Meanwhile, the Bank of England has hiked interest rates for the second time in 3 months. Policymakers agreed to lift the cost of borrowing from 1/4 to 0.5 percentage point as they try to rein in those spiraling price rises. Inflation in the UK is at a nearly 30-year high of 5.4%, and the Bank of England expects it to peak at just above 7% in April. The UK, European, and American central banks all target medium-term inflation of around 2%. Well, in the UK, as in much of Europe, the soaring price of energy has driven that high inflation. British providers have a price cap. That's a maximum amount that they're allowed to charge for each unit of energy. That cap is now being increased by half. The government has unveiled new aid for millions of households facing those higher bills, as Wasim Cornet reports.
It's news that will have Britons dreading their next energy bill, an eye-watering price hike the country's energy regulator says it's forced to implement due to soaring gas prices. As of April, the price cap on gas and electricity will jump from just under £1,300 to almost £2,000, a 54% increase, and that means more pain for millions of people.
Life's tough as it is for me, but it's going to make it even more tougher.
I can't see us ever, wanting to spend enough to be able to be warm all the time. Yeah, we just put on extra layers. Got used to it.
Although consumers will have to bear the brunt of the surge, the government is stepping in to soften the blow of those extra £700.
The actions I'm announcing today will provide to the vast majority of households just over half of that amount, £350. In total, the government is going to help around 28 million households this year.
All British households will receive a £200 discount on their October energy bill, or about €240. That amount will be repaid in equal £40 installments over the next 5 years. Additionally, 8 in 10 households will be eligible for a £150 rebate on their council tax in April. But despite the government aid, the country's biggest trade union has called the cost of living crisis a catastrophe and warned it could plunge at least 1/4 of British families into fuel poverty.
Let's check in on the day's trading action now. The major European indices have closed lower, losses of about 1.5% in each Paris and Frankfurt, about 3/4 in London there. The euro jumped to a more than 2-week high against the dollar on that news from the ECB. Wall Street's also firmly in the red, reversing a 4-day winning streak. The Dow Jones down nearly 1 percentage point, the S&P 500 1.7, the Nasdaq 2.7 there. The tech sector is dragging down overall trade as Facebook reported disappointing quarterly results that sparked jitters among other tech firms and investors. Well, shares of Facebook's parent company have plunged 25% today, wiping $200 billion off of the company's market value. For the first time in the platform's 18-year history, Facebook reported a drop in user numbers at the end of 2021. The shift, although small, is a sign that Facebook's rapid growth has stalled against rivals like TikTok. Across all of the apps that are owned by Meta, Facebook, Instagram, WhatsApp, and Messenger, there was a slight increase in daily numbers, but not enough to reassure investors.
I think Facebook has a Mount Everest-like battle, an uphill climb to get back to growth. Because what we're seeing on the digital advertising side, the privacy issues, TikTok competition, this is a company, they changed their name. But the strategy and the monetization continues to be social media. And this was the dark days in terms of what we saw from the quarter.
The chief executive of Spotify has been speaking about the controversy surrounding podcaster Joe Rogan. Daniel Ek says it's too early to say what impact that debacle will cost the company, but shares in the streaming service plunged by over 15% today after it warned that its growth will also slow down this year. Yuka Royer has more.
Strong financial results from Spotify amid growing controversy. The streaming service saw a jump in users, up 18% to a record 406 million. Revenue from its premium services jumped 22% to 2.3 billion euros, thanks to its 180 million paying listeners. Earnings from advertising jumped 40%, underscoring the success of the streaming giant's foray into the podcast business. All the more reasons that the recent outrage over Joe Rogan, the host of Spotify's most popular podcast, causes concern.
It's a really difficult balancing act. On the one hand, it relies upon artists for the vast majority of what it is today, but it relies on podcasts for what it hopes to be the majority of what it will be in the future.
The broadcaster has been accused of spreading COVID misinformation through his podcasts. Last week, Neil Young and Joni Mitchell left Spotify in protest, and the company added a warning to all podcasts discussing COVID-19. In a call with investors, Spotify's chief executive said it was too early to gauge the impact of the controversy, adding,
"We don't change our policies based on one creator, nor do we change it based on any media cycle or call from anyone else."
Worries about future growth hang over the company. It's expecting smaller subscriber increases in coming months.
More on that story to come, Francois.
All right, many thanks for that, Kate Moody, who will be back with the closing word on Wall Street.